Hey everyone, welcome back to Corporate Decoder, the place where we make sense of corporate filings so you don't have to. Today we are diving into Tutor Perini Corporation's latest proxy statement. Usually these documents are a bit dry, but trust me, there's some interesting stuff here. Think boardroom drama, executive paychecks, and a CEO transition. All in this report. We're talking about Tutor Perini, a big construction company that builds everything from highways to buildings. The main thing in this proxy statement is a shareholder vote on some key issues, including who gets to be on the board, how much executives get paid, and changes to their incentive plan. It's like the shareholders get to play Simon Cowell, but with company strategy. First, let's look at what shareholders are voting on. They'll be electing directors, deciding whether to approve the company's choice of auditors, giving a thumbs up or down on executive pay, and voting on an updated incentive plan for employees. The board is recommending that shareholders vote for all of these proposals. So let's dig into each of these to see if that recommendation makes sense. The proxy statement lists the 10 nominees for the board of directors. There are some familiar faces and one new one. Gary Smalley, the new CEO, is joining the board. It's a pretty standard mix of experience, from construction to finance. Notably, most of the board is considered independent, meaning they don't have close ties to the company's management, except for Ronald Tutor, Gary Smalley, and Sidney Feltenstein. Now, let's talk about corporate governance. Tutor Perini highlights some of their key governance practices, like having a lead independent director, annual director elections, and stock ownership guidelines for executives. All pretty standard stuff designed to keep management accountable. The big news here is the CEO transition. Ronald Tutor, who has been at the helm for a long time, transitioned to executive chairman, and Gary Smalley took over as CEO. This section discusses Mr. Tutor's history with the company. It emphasizes the strategic mentoring and development of top executives over the past decade. The agreement outlines the timing, responsibilities, and compensation relating to Mr. Tutor's transition from Chief Executive Officer, FCO. I2's annual base salary increased from 125% to 15% to Executive Officer, CEO. His annual base salary increased from $1 Smalley's promotion, $2 of his annual base salary. And his target annual long-term incentive opportunity increased from $3 million to $4 million to 1.25% to 15% dollars annual base salary increased from 1.1 million to 125% to 15% of his annual base salary, and his target annual long-term incentive opportunity increased from $3 million target annual incentive opportunity increased from $3 million to $4 million. Upon transitioning from CEO to executive chairman, Mr. Tutor's total target annual compensation was set at approximately $8.3 million, a decrease of 37% compared to his total target annual compensation of approximately $13.2 million in 2024. The final year in which he served as CEO, Mr. Tutor's total target annual compensation will further decrease by 8% in 2026 to $7.7 million. The board recognized the desire expressed by certain shareholders that there be a meaningful reduction in the total compensation of approximately $22 million. The board reckons in the new role, the board balanced the shareholder desire with the need to appropriately compensate Mr. Tutor for his guidance, advice, and contributions over his remaining service with the company, which are critical to ensuring a successful CEO transition. The Compensation Committee also continues to evaluate and adjust the compensation paid to the company's other named executive officers. In particular, in March 2025, the Compensation Committee reviewed the contributions of the other executive officers during 2024 and their compensation levels as compared to the company's compensation peer group. As a result, for 2025, the compensation levels as compared to the company-based incentive compensation award at $900,000 in value. 3 set Mr. Ariaturd's target equity-based incentive compensation award at $900,000 in value. 2 set Miss Azari's target annual cash incentive opportunity at 90% of base salary and her target equity-based incentive compensation award at $900,000 in value. 2 set Miss Azuri's target annual cash incentive opportunity to 90% of base salary and her target equity-based incentive compensation award at $900,000 in value. Tutor Perini says they're actively engaging with shareholders, inviting top investors and proxy advisory firms to discuss corporate governance, compensation, and succession planning. They said they engaged with shareholders representing approximately 25% of our outstanding shares, as well as with one of the proxy advisory firms. It sounds like they're trying to be more responsive to investor concerns. Now let's get into the numbers. The filing highlights some impressive figures for 2024 to frick dollars, $503.5 million, up 63% year over year, set Canadian dollars on $27 million, or 524, up 843.55 and recording $1.12% year over year, driven by an unprecedented 12.84% year over year, driven by an unprecedented $1 of December 12.84, up 84% year over year, driven by an unprecedented 12.84% year over year, driven by an unprecedented 12.80 over debt reduction, reducing total debt by $47 million of 2024, up 84 revenue of 4.34. 2024 fund year to have 12% year over year, driven by an unprecedented $12.8 billion of new awards and contract adjustments in 2024, ex 82% year over year for 2024, up 8 Sadru of 4.3 billion for 4.7 billion. In 2024, the performance of our named executive officers under the company's annual incentive compensation program were operating cash flow at 143.9% of target and pre-tax income. At 0% of target, individual performance results were based on our compensation committee's largely subjective review of the named executive officers' achievement of preset individual goals. This says something about how profitable their new project and dispute resolution was, DEL ELCPSUs, based on the relative performance of our stock relative to our peer group companies over the 3-year performance period, while the CPSUs based on relative TSR paid out at 460.15% of target based on the relative performance of our stock relative to our peer group companies over the 3-year performance period, while the CPSUs based on relative TSR paid out at 14.615% of target based on the relative performance of our stock relative to our peer group companies over the 3-year performance period, while the CPSUs based on pre-tax income growth did not pay. The board is requesting shareholder approval of the Omnibus Incentive Plan as amended and restated to increase the number of shares available for awards by 2 million shares and to extend the term of the plan through April 10, 2030. The reason for this request is to, among other things, ensure that we are able to enhance our long-term share-based incentive program by offering awards to a larger number of key employees. The Compensation Committee believes that its executive compensation and benefits philosophy and objectives have resulted in a program that aligns our executives' interests with those of our shareholders. Therefore, we do our majority of neo compensation is performance-based in performance use and for what we do in majorates. Majored each's interests with those of our shareholders or for the what wad. Do a majority of neo compensation is performance-based in no dividends paid on unvested equity awards, no change in control, excise tax gross-ups. Another vote is to ratify Deloitte and Touche as the company's independent auditor. The Audit Committee recommends its appointment, the following categories and amounts. TIV during the years ended December 31, 2024, and to in the Tharding 24 and 2023, we retained Deloitte to provide services in the following categories and amounts of this audit fees. In 2024, they were 4,700 and then in order to provide services in the following categories and amounts. SOT audit fees. In 2024, they were $4,073.500. Now for the say on pay vote, shareholders get to give their opinion on how the top executives are being compensated. This is a non-binding advisory vote, but it's still important because it sends a message to the board after a full parole. We ask our shareholders to vote for the following resolution at the annual meeting, act of fault, that the shareholders approve the compensation of the named executive officers as described in the CD&A, tabular disclosures and other narrative executive compensation disclosures in this proxy statement as required by the rules of the Securities and Exchange Commission. The following table sets forth biographical information regarding the current executive officers of the company, other than Mr. Smalley, whose biographical information is set forth under Proposal 1, Election of Directors, Board of Director Nominees. This section goes into detail about how the executives are paid. The goal is to align executive pay with company performance and shareholder value. That seems pretty good, so let's see if it's actually the case. It's all about pay for performance here, which seems good in theory, but the execution is the key. This means the compensation paid to executives should be closely aligned with the performance of the company relative to predetermined performance targets. As a result, our executive compensation program rewards executives when performance results meet or exceed predetermined targets. The company focuses on strategic goals such as growing backlog and revenue, profitable project execution, and generating strong operating cash from ongoing and future projects, and the successful resolution of claims and unapproved change orders. The company focuses on strategic goals such as growing backlog and revenue, profitable project execution, and generating strong operating cash from ongoing and future projects, and the successful resolution of claims and unapproved change orders. The company also aims to be competitive in attracting high-quality executives. For 2024, all of our NEO's short-term incentive compensation opportunity was performance-based, and more than half of their aggregate long-term incentive compensation opportunity in 2024, as well as over the past 5 years, has been performance-based. The primary elements of compensation provided to each NEO are base salary, annual incentive compensation, and long-term incentives, each of which is discussed below. The 3 metrics used to evaluate the performance of our named executive officers under the company's 2024 annual incentive compensation program were operating cash flow 65% and 20 established a target annual incentive opportunity for each NEO, stated as a percentage of each NEO state's salary. Since our 2024 annual meeting of shareholders, we invited our top 25 institutional shareholders representing approximately 59% of our outstanding shares and 2 leading proxy advisory firms to have a dialogue and engage with shareholders representing approximately 25% of our outstanding shares, as well as with one of the proxy advisory firms. Our discussion topics included, among other things, the transition of the role of CEO from Mr. Tutor to Mr. Smalley, including the fact that, as previously mentioned, Mr. Smalley's compensation package as CEO more closely aligns to the median of our compensation peer group, our recent change to a majority voting standard for uncontested director elections. The following table summarizes various concerns that have been expressed by shareholders over the past several years and how we have addressed those concerns. Here are some of the notable changes shareholders wanted: lower CEO pay and a performance-based long-term incentive compensation program. The Compensation Committee annually establishes and approves a compensation peer group and a relative TSR peer group, TAMD, in 2024. The company granted our CEO performance-based equity awards that are earned and paid based on the company's TSR relative to a peer group of companies. The primary elements of compensation provided to each NEO are base salary, annual incentive compensation, and long-term incentives, each of which is discussed below. The Compensation Committee approved the grants of CPSUs, as listed in the below table, with the value of each award based on the target level of performance converted to a target number of units based upon the 20-day average closing share price ending on January 1, 2024. In 2024, the Compensation Committee approved the grants of CRSUs. In 2024, the Compensation Committee approved the grants of CPSUs as listed in the below table, with the value of each award based on the target level of performance converted to a target number of units based upon the 20-day average closing share price ending on January 1st, 2024, relative TSR peer group, as well as CPSUs that vest based on the company's relative TSR over a 3-year performance period as compared to the company's 2024 relative TSR peer group, as well as CPSUs that vest based on the company's annualized stock price growth over a 3-year performance period as compared to the company's 2024 relative TSR peer group, as well as CPSUs that vest based on the company's annualized stock price growth over a 3-year performance period ending December 31's 2024 relative TSR peer group, as well as CPSUs that vest based on the company's annualized stock price growth over a 3-year performance period ending December 31, 2026, calculated on a year-over-year basis. Mr. Arikat, Ms. Azuri, and Mr. Smith. In accordance with our pay-for-performance philosophy, certain prior year performance-based equity grants for our NEOs were forfeited or paid out below target, and certain grants were paid out at above target. Pursuant to a letter agreement Mr. Arikat entered into with the company in connection with his appointment as Executive Vice President of the Building and Specialty Contractor Groups, Mr. Arikat received a $300,000 annual incentive compensation payment on April 1st, 2024. In connection with Mr. Smithson's departure from the company in 2024, related to an internal reorganization, we entered into a separation agreement, pursuant to which Mr. Smithson received certain separation benefits as described below, in exchange for his general release of claims in favor of the company and continuing compliance with all restrictive covenant obligations. On August 25, 2021, and effective as of June 1, 2021, the company entered into an amended and restated employment agreement with Mr. Tutor. The amended agreement extended Mr. Tutor's employment term through December 31, 2026. Mr. Tutor continued to serve as the company's chairman of the board and CEO through December 31 through December 31, 2026. Mr. Tutor continued to serve as the company's chairman of the board and CEO through December 31, 2021. The company entered into an amended and restated employment agreement extended Mr. Tutor continued to serve as the company's chairman of the board and CEO through December 31 to 26. The SEC's roles for identify encapsulate and calculate a pay ratio based on that employee's annual total compensation allowed companies to adopt a variety of methodologies. As a result, the pay ratio reported by other companies may not be comparable to the pay ratio reported by other companies, may not be comparable to the pay ratio reported below. The annual total compensation of Mr. Tutor is measured for reporting in 97 to 1 coupled to the pay ratio report in 27. The ratio of the annual total compensation of Mr. Tutor as measured for reporting in the SCT was 26,040 2024 to the annual total compensation of Mr. Tutor as measured for reporting in the FDARS. We expect it to decrease substantially compared to the ratio of the annual total compensation of Mr. Tutor in 2024. Total compensation of Mr. Tutor as measured for reporting in the SCT was $26,000 for 2024. Total target compensation, the CEO pay ratio for 2025 is expected to decrease substantially as required by Section 953(a) of the Dodd-Frank Wall Street Reform and Consumer Protection Act and Item 4022. Of Regulation SK, we are providing the following information about the relationship between the compensation actually paid to our NEOs and certain financial performance of the company. Each year, management and the compensation committee review our employee compensation policies, including the annual incentive compensation we provide to our NEOs in relation to market data for our peer groups, including evaluating the mix of compensation elements, performance metrics and targets, and risk management practices. Based on this review, the company and the compensation with our business strategy and do not encourage behavior that could create material adverse risks to the company. The last point for voting is to ask our shareholders to approve 2,000 additional shares to be authorized for issuance. It's an incentive and retention mechanism for our employees, consultants and non-employee directors. So what's the story here? Tutor Perini is going through a leadership change, and they're trying to reassure investors that everything is under control. They're touting record cash flow and backlog, but also acknowledging past pay practices that rubbed some shareholders the wrong way. The company has addressed those concerns. The board is requesting shareholder approval of the Omnibus Incentive Plan. This is definitely a company in transition. On one hand, they're boasting about record financial performance. On the other hand, they're still dealing with the fallout from past compensation practices. The transition from Mr. Tutor to Mr. Smalley is a really interesting story, especially how they dealt with the transition compensation. The challenge will be maintaining momentum and building trust with investors. I think it will. The company has great cash flows, but execution will be key. Alright. That's it for this deep dive into Tutor Perini's proxy statement. Let me know what you think in the comments below. If you enjoyed this video, please subscribe and hit the like button for more corporate decoder content. Thanks for watching, and I'll see you next time.